January-March 1913. Economic tensions and public distrust. Crowded factories, old banks, headlines about financial panics. Bustling Wall Street scenes. The world in 1913 stood on the edge of change. In the United States, public anger toward banks was rising. The country had endured repeated financial panics, especially the crisis of 1907, when banks collapsed and chaos spread across the economy. Ordinary citizens demanded a safer financial system. Politicians and economists debated. Should the government step in to stabilize the economy? At the same time, Woodrow Wilson was inaugurated as president, bringing new ideas and bold promises of reform. April-June 1913. The push for reform. President Wilson taking office. Congressional meetings, newspaper articles pushing for economic reform. As spring arrived, President Woodrow Wilson began pushing for a complete overhaul of the U.S. banking system. He teamed up with key figures like Senator Robert Latham Owen and Representative Carter Glass to design a bold new solution. The goal? To create a central bank that could protect the U.S. economy from financial instability, prevent bank runs, and regulate the money supply. Bankers, business owners, and farmers all had different opinions, but the movement for reform kept gaining momentum. July-September 1913. Drafting the Federal Reserve Act. Typewritten drafts of legislation. Washington, D.C. buildings. Debates in Congress throughout the summer. Lawmakers worked tirelessly to draft the Federal Reserve Act. They proposed a system of regional banks overseen by a central authority, giving flexibility to address local economic needs while limiting concentrated power. Critics feared giving too much control to Washington or elite financiers, but supporters argued America needed a modern banking system to support its rapidly growing industrial economy. October to December 1913. The Federal Reserve becomes law. President Wilson signing the bill. Vintage U.S. Treasury building. Public reactions. On December 23, 1913, after months of heated debate and revision, President Woodrow Wilson signed the Federal Reserve Act into law. The United States now had a central banking system, the Federal Reserve, tasked with managing the money supply, setting interest rates, and responding to financial crises. The system divided the country into 12 Federal Reserve districts, each with its own regional bank. This quiet yet powerful reform would shape the future of global finance in ways no one could have foreseen. Historical significance. Timeline of financial crises. Central bank maps. Modern U.S. currency. Stock market footage. The creation of the Federal Reserve System in 1913 was one of the most influential financial events in modern history. It gave the U.S. a powerful tool to stabilize the economy, control inflation, and regulate interest rates. In time, the Federal Reserve's influence would stretch far beyond America, affecting global trade, investment, and economic policy. It marked a turning point, from a laissez-faire approach to one where governments took an active role in maintaining financial stability. Key figures involved. Archival photos with nameplates and short bios. Woodrow Wilson, U.S. President who led the effort and signed the Federal Reserve Act. Carter Glass. Congressman and lead author of the Federal Reserve legislation, Robert Latham Owen. Senator and co-sponsor of the bill, Paul Warburg. A visionary banker who championed central banking reform, the American people, workers, farmers, and citizens who demanded a safer, fairer economy, like, share, and subscribe, for more powerful events that shaped the modern world, told year by year. Comment below. Was the creation of the Federal Reserve a necessary reform, or the start of too much government control? We want to hear your thoughts.